Hello, my name is Antonio Lavero, and I work in LaGuardia Community College's Student Financial Services Office. Today we're going to present one of our workshops that is part of the Smart Money workshop series. Today's topic is student loan repayment. So welcome, and we're going to get started. Here are our learning objectives for today's workshop. First, we want you to learn what student loan deferments are available in case you're experiencing problems in repayment. Learn about the different types of student loan repayment plans, and learn about the various federal and state loan forgiveness programs. There are three types of federal loan programs. There is the federal direct student loan programs, there is the federal Perkins student loan program, and there's the federal family education loan program. The Federal Direct Student Loan Program is the current main student loan program in our country, and that is the program that students are borrowing under currently. The Federal Perkins Loan Program ended about 2 years ago, so students are no longer able to borrow under the Federal Perkins Loan Program, but some students may have an old Perkins loan, so we wanted to make you aware of it. And then there's the Federal Family Education Loan Program. It is the another older program that students could have borrowed under in the past. So let's go to the main Federal Direct Student Loan Program, the current program. It has a series of sub-student loan programs. For students, students can borrow under the Federal Direct Student Loan Subsidized Loan Program and Unsubsidized Loan Program. What are these two programs, and how are they the same, and how are they different? Well, they both have the same interest rates and fees. Both postpone payments during the time that you're in school, attending at least half time, which means you're taking 6 credits in a respective semester. So what's different? The difference is that under the Federal Direct Subsidized Student Loan Program, the federal government pays the interest that accrues on your student loan during qualifying deferments, like an in-school deferment, an unemployment deferment, or an economic hardship deferment. An unsubsidized loan program, the federal government does not pay the interest that accrues. So that's one difference. The second difference is that subsidized is a need-based student loan program, which means you have to show financial need in order to receive that program. Unsubsidized, you do not have to show financial need. Now, most students in our country are eligible for both subsidized and unsubsidized. But if you have a student or a family with a high income, they may only be eligible for the unsubsidized loan program because it's a non-need based program. There's also the PLUS loan program, and again, it has two subparts. There's the undergraduate parent student loan program, where parents borrow for undergraduate students. Parents are the actual borrower. And then there's the graduate plus loan program, where graduate students can borrow additional money in addition to the unsubsidized loan under the grad plus loan program. And then third, there is the federal consolidation program. What is that? That's a way where students can combine different loan programs, like a Federal Perkins loan or a Federal Family Education Loan program, into a new federal direct loan, so they have only one loan and it makes their repayment simpler. This screen shows the National Student Loan Data System, or what's called NSLDS. You see the website nslds.ed.gov. You should become familiar with this website. When you go to NSLDS, you can see two things. First, you can see your loan summary, and secondarily, you can also see who your student loan servicer is. What is a student loan servicer? Well, under the Federal Direct Loan Program, the lender is the federal government, but the federal government doesn't service your loan. It doesn't send out bills, answer your phone calls, process payments. They contract with what is called a federal student loan servicer. Now, when you had your loans dispersed, or when you're about to go into repayment, your servicer is going to send out disclosure information and other correspondence to you, introducing themselves and letting you know who your servicer is. And this chart here shows the different types of student loan servicers. For example, Navient, Fed Loans, Okay, those are some examples. There's about a dozen federal student loan servicers. Okay, CUNY uses for their Perkins student loans a company called ECSI as the servicer. And so in case you hear information from ECSI, that is your Perkins servicer. And again, these others are federal direct student loan servicers. And it's important for you to know who your servicer is, because they're the entity, the company that you will interact with when it comes time to repayment and when it comes time to discuss your repayment options that we'll be discussing today. So once you graduate, do you immediately go into repayment? No, you don't. The federal government gives you a grace period under the federal direct student loan programs. It's 6 months, okay, when you either graduate, withdraw from college, or drop below half-time attendance. Your grace period will begin. With Perkins, it's a 9-month grace period. During your grace period, under the direct and Perkins loan program, there is an interest subsidy during the time that you're in your grace period. So you begin making payments 30 to 45 days after your grace period ends. You can make a payment at any time. There's no prepayment penalty. So if you decide you would like to make a payment during your grace period, you certainly can. What happens if you can't make your payment when it is scheduled? What can you do? What options do you have available? Well, you have many options. There are, under the direct student loan and Perkins loan program, you have options to apply for a deferment. Like an unemployment deferment or a economic hardship deferment. Okay, so if you're not working, you're unemployed, or if you're underemployed, working less than 30 hours a week, you may be eligible for an unemployment deferment. Or you can apply for forbearance, where you postpone the payment on your loan temporarily. And there are also some cancellations, which we will speak about in a little bit more detail. So they are deferments, forbearances. But in addition to that, you can also apply for what are called income-driven student loan repayment plans. And we're going to, again, go into those in detail. So repayment relief under deferments. You can postpone your payments under certain conditions. The federal government will pay the interest that accrues on federal direct subsidized and Perkins loans during the time that you're in a qualifying deferment. The length of time varies by type of deferment, and no deferments are automatic. You have to apply. So one of the things that I emphasize with students is you need to make sure you communicate effectively with your servicer, because you may be eligible for, let's say, an unemployment deferment, an economic hardship deferment, some other program, but it's not automatic. You're going to have to call them, explain the circumstances that you are experiencing, and they'll work with you to make sure you go into the right program. Different types of deferment programs. I'll give you some examples. The first one is during the time that you're in school, you received an in-school deferment where your payments are postponed and the federal government paid the interest for you under the subsidized student loan program. Unemployment deferment, we briefly reviewed that. So if you're not working or working less than 30 hours, 6 months at a time, up to a total of 3 years, you can get an unemployment deferment. If you're working over 30 hours, you can apply for an economic hardship deferment. The total length of time of an economic hardship deferment is 3 years. There's a full-time graduate fellowship, rehabilitation training programs, and active duty military deferment programs that are also available. Again, contact your servicer to explain your circumstances, and they'll help you to apply for the deferment program that's best for you. So repayment relief, cancellation or discharge. You can have full cancellation if there's death of the borrower, if there's a school closure before you were able to complete the program, before you were able to graduate, if there's false certification by the school, if there's fraud, you can have your loan discharged or canceled, and or identity theft. Loan discharge can occur if you have documentation from a physician showing that you are total and permanently disabled and you cannot repay the loan, and you can apply for a discharge of that loan. And under some limited cases of bankruptcy, you may also be able to have the loan discharged, but that's rare. Forbearance. So forbearance is a little bit different than a deferment. You can apply for a forbearance. Most of the time, what I like to say to students is, you should use a forbearance in a very temporary and targeted way. Why? Because you should always try to apply for a deferment, especially if you have subsidized loans, because with deferments or income-driven repayment plans, you may have the benefit of interest subsidy during those type of programs. In most cases with forbearance, the federal government will not pay the interest for you regardless of the loan type unless it's very specifically announced. Okay, so generally forbearance is used when a borrower is willing but temporarily unable to make payments due to financial hardship. But in most cases, you can apply for deferment, like an unemployment deferment or an economic hardship deferment, in place of a forbearance. Now we're going to start to get into student loan repayment plans. So this is the standard repayment plan. Everyone will go into the standard repayment plan once you your grace period expires. This is the one you go into automatically. There's a 10-year repayment term. Okay, payments are fixed. There's a minimum payment of $50 a month. And again, everyone goes into this program automatically. So if you borrow $10,000, your payments are going to be around $100, $110 under the standard repayment plan. Graduated repayment. What is this? This also has a 10-year repayment plan. But the way this works is, it basically says that, let's say you borrowed $10,000 and your payments are $100 a month. Well, under the graduated repayment plan, for the first 2 years, your payment could be, let's say, $80. And then for the next 2 years, it could be $90. Then the next 2 years, it could be $100. And then the next 2 years, it could be $110. So they start out a little bit lower than standard, and they gradually go up over time. And some students like this plan. Why? Because most of us, when we first start our careers, we're not making as much as we will in 6, 8, 10 years down the line. So the graduated repayment plan is something that you may want to consider. This is the extended repayment plan, and this one I really ask you to be very, very careful with this payment plan. Sometimes this plan is attractive. Why? Because it extends the term. You can see the term goes out to 25 years. But if you extend term, that means you're paying interest over a longer period of time, and the loan is going to be more expensive for you. So be careful with the extended repayment plan, because it generally adds interest costs to you, and you have better alternatives today that you did not have in the past, and those are specifically the new income-driven repayment plans. So income-driven repayment plans started under President Clinton, and they have been enhanced over time. The plan that we're looking at here was created by President Obama. It's called the Pay-As-You-Earn Repayment Plan. It's something that you should certainly know about. A lot of people like it. Is it perfect for every student? No. Why is it not perfect? And we'll go over the details of it in a second. Well, if you're going to repay your loan in 8 years or 10 years, then you may not need an income-driven repayment plan, and it may not be a good program for you. But for some students, especially those students with modest income and high student loan balances, you may want to look at and discuss with your student loan servicer the Pay-As-You-Earn student loan repayment plan. So let's look at it. First, again, it's not automatically. You have to apply each year. When you apply, you will provide to your servicer your income and your number of dependents to determine what your student loan payment will be. And you have to do that annually. Okay, so there's an annual certification for this plan. In addition to that, if you're in this program and you're making payments for 20 years and you still owe a balance, the remaining balance will be forgiven. So there's a forgiveness component to the Pay-As-You-Earn repayment plan. Okay? So this is a good plan. You should definitely have a conversation with your student loan servicer. See if it's something that's going to work for you. Ask questions. But it's a good plan, and it's something that you should really consider. If you have a certain amount of money, let's say you have $500, $1,000, $2,000 forgiven, keep in mind that loan forgiveness is considered income, so you will have to pay taxes on the amount that was forgiven. And under this program, if your payments are below the amount that you need to pay in interest for the first 3 years, the federal government will pay the interest for you for those first 3 years. So that's another benefit of this program. Let's look at some examples under the Pay-As-You-Earn Income-Driven Repayment Plan. So you see a chart. It's pretty straightforward. Let's say you graduate and you borrowed $20,000. Well, let's just say if you borrowed $20,000, your payments would be around $220 a month, just as an example. But if you're single, making $35,000, your payments are not $220, they're $152. So you can see your payments are based upon your income and your family size. So let's look at another example. Let's say you're making $50,000, and again you borrowed $20,000, but you're married and you have a child. So now you go to the chart, 50 and family size of 3. So instead of your payments being $220 a month, they're $178 a month. So those are 2 examples. I do want to illustrate one other item to you. So let's just look at someone who's making $20,000 and they're married. They're just starting out, and they borrowed $20,000 during their college career. So you can see if it's $20,000 and there's 2 people, the repayment is the repayment amount is 0. So your payments under Pay-As-You-Earn can be 0. Now let me ask you this question. Let's say, use the same example. Your payments are 0. You're in the Pay-As-You-Earn program. Does that first year where your payments are 0 count towards your 20 years? And the answer is yes, it does. Okay, so that first year of payment, or the first 12 payments, even though it's $0, counts towards your 20 years. So President Obama created the Pay-As-You-Earn program, and it had some restrictions. I'll show you some of the restrictions right up here. It says for those students that had a loan prior to October 1st, 2007, but did not have a disbursement after October 1st, 2011, if you are not borrowing a new federal direct student loan, you may not be eligible for Pay-As-You-Earn. So what he did was he created the revised Pay-As-You-Earn plan, which incorporated more of us to be able to apply for an income-driven repayment plan. So this is a way to expand the income-driven repayment plan. That's one of the things that revised Pay-As-You-Earn offers. It also offers some benefits specifically to graduate students. And without getting into too much detail on that, what I can say is if you have undergraduate and graduate loans, definitely speak to your student loan servicer to see which program may be most beneficial to you, and your servicer will work with you on that. Okay, so now let's talk about repayment relief or forgiveness. There are many types of federal loan forgiveness programs. For example, if you're in the military, you could have a direct monetary disbursement issued to you, and you can use that to pay down your student loans. National and Community Service, so the Peace Corps, AmeriCorps, they will also give you a payment that you can use to pay down your student loan, to have a portion of your loans paid off. There's a very significant teacher loan forgiveness program where you can have up to $17,500 issued to you to pay down your student loans. And that's a significant program, the Teacher Loan Forgiveness Program. There's another loan forgiveness program that's called the Public Service Loan Forgiveness Program. So let's talk about that one a little bit. If you work in the public sector, what is the public sector? That means you work for the city, state, federal government, or qualifying not-for-profit. If you work in the public sector, then you could benefit from the Public Service Loan Forgiveness Program, which basically says that you do not have to pay for 20 years, you only have to pay for 10 years before you benefit from loan forgiveness. So obviously that's a very significant benefit. And that's the Public Service Loan Forgiveness, or the acronym is PSLF. It's written about in the New York Times, the Wall Street Journal. It's talked about in the news a lot. And those of us who work in the public sector should definitely contact their student loan servicer, ask them about the Public Service Loan Forgiveness. Now, if you are applying for the Public Service Loan Forgiveness Program and you're with, let's say, Navient as a student loan servicer, once you apply, you will automatically be moved over to Fed Loans. Why? Because they're the only servicer that handles public service loan forgiveness. Okay? But it's an excellent program and you should definitely look into it. If you are going to apply for these programs, you can still apply in combination with an income-driven repayment plan. So for example, let's say I'm working in the public sector, I'm in the Pay-As-You-Earn program, so now my payments are based upon my income and my family size. I can also apply for the Public Service Loan Forgiveness Program. How do you apply for the Public Service Loan Forgiveness? You go to the website that's listed here, you print out a employment certification form, which basically you bring to your human resource department, and they certify you work at that public sector job. It's an excellent program, and again, speak to your servicer about it. This is another great loan forgiveness program. It's offered through the state of New York. It's called the New York State Get On Your Feet Loan Forgiveness Program, and it provides up to 24 income-based or income-driven payments like Pay-As-You-Earn on your first 24 payments of your income-driven repayment plan. There are certain qualifications. You have to be a legal resident of New York State and reside in New York State for 12 continuous months, a U.S. citizen, and again, you can read through all of these. There is an income limit for the New York State Get On Your Feet Loan Forgiveness Program. Your adjusted gross income must be less than $50,000, but it's an excellent program, and you need to look into it. The website will show you. It's the HESC website. HESC is New York State Higher Education Service Corporation, which is HESC.ny.gov, and you can go to that website and learn more about the New York State Get On Your Feet Loan Forgiveness Program. So this is a case where you can benefit through an income-driven repayment plan. You can benefit, let's say, under one of the other loan forgiveness programs, and have this added on to help you pay your first 24 payments of a income-driven repayment plan. Okay? So it's the New York State Get On Your Feet Loan Forgiveness Program. Okay, we are done with this workshop. Thank you for attending. A couple of quick points. If you apply for financial aid and you expect a refund after you pay your tuition and fees, please sign up for direct deposit. Why? Because it's safe, it's convenient, and it's fast. And you can do that through CUNY First. Last, we want to speak about LaGuardia Cares. It's part of the Student Financial Services Office. And LaGuardia Cares connects students from low-income families to life-changing financial resources such as public benefits, tax credits, and other essential services that remain untapped and may appear to be inaccessible. And LaGuardia Cares offers assistance in applying for public benefits, the food pantry, tax preparation assistance, financial counseling. They do an excellent job in helping our students. You can see the hours for LaGuardia Cares and their respective email address in case you want to contact them. Thank you very much for attending. We hope this has been beneficial to you. The last thing that I want to say is, again, make sure you're aware who your student loan servicer is and contact your servicer to explain your circumstances and make sure that you get into the right repayment plan, income-driven repayment plan, or deferment that's going to benefit you the most based upon the circumstances that you are experiencing. Thank you and have a good day.